Hi, good evening and a very warm welcome to Business Plus here on News 9. I'm Karthik Malhotra, joined by my colleague Suyash Maheshwari. We've got a fairly solid packed next 45 minutes or so. And as always, let's begin with the markets. Suyash, what's up?
Yes, Karthik. So after a muted opening, Indian markets, were seen gaining some strength in the mid-morning segment. And as a result, Nifty was able to briefly surpass the 19,700 marks. However, the market failed on to build onto the bullish momentum, and as a result the markets paired all gains and ended on a flattish note in today's trade. Now Nifty ended just at the flat line and it gained about 0.3 points in today's trade. It was up about it closed at below the 19,700 levels, whereas Sensex only gained about 14 points to close marginally above the 66,000 mark. Now the broader markets continued their outperformance. Nifty mid cap 100 gained about 0.66% in today's trade, whereas the small cap index ended on a flattish note. It was up about 0.04%. Now India VIX, the volatility index, also saw a sharp spike of about 2% in today's trade, but it sits below the 12 threshold, which indicates that the volatility is still low compared to the last 30 days.
All right, we've also got Dipan Mehta joining us. Dipan Mehta, Managing Director and CEO of Elixir Securities. Mr. Mehta, thank you so much for joining us. What's happening? We've been so used to the bull runs, which have continued for weeks and weeks, and now we are seeing a sort of flattish trade all day today. What's driving the market mood this Monday?
Yeah, thank you for having me on your show. I think it's nothing surprising. What we are seeing here is consolidation taking place within the stock market, and after the way the stock prices are moved up, especially small mid-cap stocks, we are seeing the market taking a bit of a breath over here. Also, generally, there is no fresh news flow, positive or negative, which can really move the markets at this point of time, and soon we'll be entering into earnings season. So that's going to have its own set of in stock-wise volatility, and investors like to wait and watch until we see some more news coming in from the corporate sector. So this is just pretty about normal, and I'm glad that it's not correcting as much as one would expect it to be. But at the same time, I think investors need to be cautious that there could be a correction down the corner. So as far as we are concerned, we are just adopting a wait and watch kind of a strategy at this point of time.
Mr. Mehta, I think there was also this talk about the Indian markets being overheated, and we saw when the bull run momentum was carrying on unabated. We also heard that perhaps Indian markets could be a little overheated at this moment. But with the correction, like you mentioned, not really happening, can we assume that we have indeed reached that Goldilocks situation of the markets neither being too hot, not too cold to digest?
Well, that's nicely put. But I think corrections can be of two kinds. There could be actual price-wise correction or time-wise correction, and price and time-wise correction as well. I think what we are seeing just now is largely time-wise correction. Markets really haven't really corrected as much. And this particular scenario can last for a little longer period of time as well. But as I said, I think, stock prices have moved up. Valuations are on the expensive side. Yet on the other hand, the fundamentals of the Indian economy and corporate earnings remain strong. So we have these, counterbalancing forces taking place over here. And that's what makes our markets quite interesting. But broadly, I think from our perspective, we do feel that a correction is necessary and should be around the corner. It's just a question of when, and that is a big question which you cannot answer at this point of time. But I think it will happen sooner rather than later, and it will happen suddenly without giving any warning or anything. That's how it technically does happen. But on the whole, I think considering the valuations, there's not much of margin of safety, and maybe investors just wait and watch.
Okay, and before we come to specific stocks, Mr. Mehta, I also wanted to check with you, what are the cues that you are really looking forward to right now? Because I think whatever was out there domestically and globally for the markets to digest has been well digested. So we've seen the rate pause in the US, we've seen a continued higher for longer sort of an interest rate regime, in European markets. Add to that, we are also seeing inflation and our own domestic rates pretty much in line with expectations. F&O expiry this Thursday. Markets seem to have digested pretty much everything that is there to move the markets from anything outside of corporate announcements themselves. So are there any cues that you are really monitoring right now? And I think I forgot to mention even oil prices for that matter. I think the $95 per barrel sort of a mark has been well appreciated by the markets already. So what cues should one really look for right now?
That's what I said, that we are entering into a slightly period where there is hardly any news flow. I think all the major central banks have done with their meetings for interest rate fixing, and those outcomes also are known to us. At the same time, I think oil prices going up is nothing new. So long as they don't cross $110 or so, we are pretty much protected. We've seen much higher prices than these. And whatever news flow is coming in is generally positive. I think we saw the advanced tax collections, they're looking interesting as well. So as such, there are no cues as of now, which is what I said, that there are no positive or negative news flow at this point of time. We are in a bit of a quiet, saturated period. And one of the most important strategies in the market is to do nothing. And I think that's where we are just.
Do nothing. So Yash, what do you have to add to that? Do nothing, wait and watch, wait for the next cue, which doesn't seem to be on the horizon right now.
Definitely the market is lacking cues, but in a couple of weeks time the earnings season will be kick-starting. And talking about the earnings season, Mr. Mehta, what are your broader expectations from India Inc.'s Q2 report card? Any sectors that you expect to outperform and any sectors that could play perhaps spoil sport?
Actually, it's going to be a very beautiful earnings season. That's the best way I can describe it. Because I don't see any black spots at all. In fact, technology also, some of the stocks over there may surprise on the upside. A lot of large cap tech companies have won huge multi-billion dollar orders. Let's see how they progress on implementation. Mid-cap IT was anyway doing pretty fine. They were sustaining those 12 to 18% above growth rates. Metals have also started to do better with higher margins on account of lower input costs. So I'm pretty certain that it'll be a good earnings season. But sometimes what happens that we are entering the earnings season at a so-called high, and expectations will start to build up before we enter the earnings season. And then there's even a minor miss, or even if the company is able to meet the street expectations, we have this sell on news syndrome, and that may kind of take over the market. So while I don't see any red flags in this upcoming earnings season, it's just that expectations are high, and when expectations are not just met, but beyond the expectations, the numbers don't come through, then there's somewhat of disappointment. Also, I feel that there's a lot of trader activity in the market, and I sense that there are a lot of short-term position traders also in the market. They are riding the momentum stocks, and right now I think the momentum has stopped in many stocks also. So unless we see a revival of the momentum in the next 2-3 trading sessions, maybe in this week itself, you may see a lot of tired positions being unwound as well. That's something which also I'm watching. So I think I would say that next 2-3 weeks time we could expect a more serious correction, maybe towards end of this month or maybe beginning of the earnings season. And then once the earnings season starts, then we take up from there, because typically, there are a lot of stocks, fresh news comes in over there, management commentary is important, data points are important, and, investors tend to make a better informed view of the stock once the earnings are out.
Absolutely. I think once the earnings are out, investors would be able to pick sectors and pick companies. But until that, if I may call that lull or that boring period of no cues really to look for, Mr. Mehta, for somebody who's actually investing in the markets today or wants to get, as a beginner, wants to get into the markets today, what should the strategy really be? Because for an existing investor, you're saying wait and watch and, enjoy the lull period. But for somebody who is not there in the markets yet, do you think 67,000 levels on Sensex is a good idea for somebody to enter?
No, that's a difficult one to answer because you could easily be caught on the wrong foot over here. And especially if you're sitting on a lot of cash, I'm not keen to invest at these levels. I think that although you don't want to time the market, but intuitively you do feel that there should be a correction and that's the best time to enter. Existing investors, I think, is a good time to have a hard look at your portfolio and restructure it in such a way that you're out of the underperforming stocks. creating some cash for you, and if there are some, weightages within the sectors which are not right for you, maybe you should try to correct that as well.
Right.
So broadly, I think strategy is to wait and watch. If you're sitting on cash, then remain sitting on cash, wait for a correction. If you're more or less fully invested, just reshuffle your portfolio to get the weightages and the risk profile right.
Got it. Okay, let's move on to sectors in action. Suresh, what are you picking up? How's the sectoral performance been in trade today?
Certainly, Karthik. So, among the best performing sectors today was Nifty Bank. Now, Nifty Bank last week corrected by about 3.5% on a weekly basis. However, we saw some buying interest at lower levels, and as a result, the Nifty Banking Index was able to, end about 0.35% higher in today's trade. And we saw some buying interest across financial stocks, even the PSU banks, which was the only sector which moved higher when the entire market was falling last week, continued to build onto that momentum, and the Nifty PSU Bank Index was up about 0.16%. Now, among the losers was Nifty IT. The IT pack came under pressure. Now, the IT pack was witnessing some sort of a buying interest at lower levels in the last couple of months, but it seems that the US Fed's commentary which suggests that interest rates may remain higher for longer period, and there may be another rate hike in the offing as early as a November policy meet. Yeah. So that has put pressure once again on the IT pack. Now the Nifty IT index was down about 0.78% in today's trade. Now media stocks also witnessed some selling pressure. They have been largely choppy over the last couple of weeks, and the media stocks were down about 0.73%. Other than that, FMCG pack saw some modest gains. They were up about 0.07%, as well as the private banks was up about 0.45%.
Mr. Mehta, Nifty Realty really outshines, the market trend today. What's driving realty stocks up?
So I think real estate is at a very nice, I would say, multi-year upswing with volumes picking up, and we are seeing that 2-3% type of value per square feet also looking up. I would say that a lot of the real estate companies are working in a very disciplined manner, focusing on improving the balance sheet quality, focusing on sales, focusing on collections, and not going after land bank the way they had done the last time there was a bull in the real estate market. So on the whole, I think we are seeing consolidation also taking place over here. So a lot of the large real estate companies, I think the prospects are pretty good over the next 2-3 years. Especially the larger ones, they provide some amount of de-risking strategies in place, and therefore, I would be safer with them. Having said that, companies like DLF and of course Macrotech developer, the two large ones, appear to be on a very solid footing. But the dark horse could be something like a Shobha developer. Again, it's not a recommendation, it's just our assessment, and investors should do their own due diligence before buying. But that's one company which has underperformed the broader pack, and it's a very solid company with good quality management as well. And they're also sitting on huge land bank, which they are trying to develop in a judicious manner. So I'm very positive on real estate per se, and investors should certainly look at that sector, be slightly overweight over there. You want to play it absolutely safe, then go for something like Godrej Properties, a company in which we and our clients are invested. And that also, I think, the beauty of that company is that it is pretty well spread out geographically. And that in itself, I think, is very positive from a risk profile manner.
Right. And talk to us about IT. I think Suresh was rightly mentioning that, there could be another rate hike in the US, and that could again put pressure back on the INR. So with respect to IT companies, how do you see, today's movement of IT stocks being down, IT index down about 0.8%? And overall, what is the sort of medium term or the next quarter sort of a projection for IT stocks in respect to both oil prices as well as another rate hike possibly by end of the year in the US, both impacting the Indian rupee?
See, we are positive on mid-cap IT stocks. We understand them better. These companies have been able to create their own niche within a very competitive market. And clearly, even large Fortune 500 companies are going for mid-cap IT because of their specialization, because of the kind of value proposition they bring to these larger companies. And even smaller projects, 10, 20, $30 million projects can make a huge difference to the top line and bottom line of these companies. So we feel more comfortable with the mid-cap IT, and you will say, of course, that they are more expensive. But then their growth is being supported by higher valuations. So companies like Persistent Systems, KPIT, Tata Elixir, Happiest Minds, Coforge. I think they are having industry-leading growth rates, and that gives comfort that even if you have to pay a higher P multiple, if these growth rates are sustained, then these companies can still turn out to be outperformers and give reasonable returns. Again,
Right.
all of these companies, due disclosure is required.
Right. So I think a sweet spot for IT mid-cap companies, Soyash, and a sweet spot for sugar stocks, or tending to go a little bitter.
Sugar stocks actually have been in a sweet spot for quite some time now, and at least in the last couple of months we have seen a significant run up on the back of expectations that there will be a shortfall in production, and as a result the prices of sugar have surged to about a 6-year high. Now even today the stock prices were rallied as much as 7% in intraday trade today, and the expectation is that again the lower production will will put pressures on the price, and the price are expected to rise once again. Now how much, now Mr. Mehta, my question is, how much of these higher prices can sugar companies pass on to the end consumers?
Oh, that's a difficult one to answer because there's a great deal of government regulation as well. But any hike in sugar prices is beneficial for these companies. And if you have really been observing the way these companies have been growing, there are more and more now ethanol companies and less sugar companies. Of course, they'll always remain sugar companies, but 30-40%, a lot of these sugar companies, the revenue and profits are coming from ethanol. And from that perspective, how the ethanol prices move, especially what the government is paying for it, is very important. On the whole, we are positive on sugar because of the ethanol opportunity, because of reasonable valuations at a time when I think every business is trading at premium multiples. Return ratios are good. It's a business which has got very high entry barriers because of locational nuances, and also, getting fresh sugar stock, molasses, rather sugar cane is not that easy. So there are certain very high entry barriers as well. But at the same time, there's heavy government regulation. So on the whole, I think generally positive on sugar, but one needs to be a bit selective and go for the larger sugar companies over here, especially the ones which are focusing extensively on ethanol production.
Okay, so I think high entry barriers, government regulation. Why would any sugar operator not want to, pass on the high prices back to the customer if there isn't much competition that's likely to emerge? But let's look at maybe, the gainers and losers today before we let Mr. Mehta go, Yash.
Yes, Karthik. So among the gainers today was Bajaj Finance. Now the stock gained about 4.5% in today's trade after media reports suggested that the company is looking to raise about 800 million to about $1 billion via QIP or a preferential issue route to fund future growth. Now details of the mega fund raise will be discussed in the company's board meeting, which is on October 5. Now following the development, CLSA, which already has a buy rating on the stock, has raised the target price on Bajaj Finance to about 9,500, implying an upside of about 27% from current levels. And Jefferies is also bullish on the stock, and it expects the FY24 earnings per share and book value per share to rise about 6% and 11% after the fundraise. Now buoyed by the gains in the subsidiary, Bajaj Finserv also saw some run up. It was up about 2% in today's trade. Among other gainers were Tata Consumer Products, Apollo Hospitals, which gained about 2%, and Coal India, which continues on its run. The stock was up about 2% after taking a breather last week.
Okay, let's move to the losers, Sayash, who, apart from Delta Corp, who else do we have on the loser stock today?
So among the blue chips, Karthik, Hindalco was I think the top loser today. The stock was down about 2%. Now the stock has been, it has gained about 20% or so in the last 6 months. But now there are concerns that labor shortage will be there in the aluminium industry. As a result, the stock is seeing some selling pressure at higher levels. And perhaps after the recent run up that we have seen in the Hindalco stock, there is some base building activity going going on before the stock starts another leg of uprun. Infosys, which has also gained about 4% in the last month or so, saw some profit booking and the stock was down about 1.4%. Other losers among blue chips were SBI Life, which was down about 1.77%, Hero MotoCorp, which was down about 1.63%, and Mahindra & Mahindra, which lost about 1.25% in today's trade.
All right, Sriyash, thank you so much for that update. Mr. Mehta, before we let you go, I think one stock, of course, we've looked at the blue chips, but one stock that really took a massive beating today was also Delta Corp. And we've seen the sort of retrospective taxation which is happening on online gaming companies. What's your broader view on the e-gaming sector, Mr. Mehta?
First, the disclosure, unfortunately, we are shareholders of Delta Corp. And, and we are sharing.
Not a good day to be a shareholder of Delta Corp, sir. My apologies to you. But how do you see the sector?
See, it's such a tempting business proposition. I mean, Indians love to gamble, and this is the only listed gambling company per se. And mind you, if you go globally, a lot of these companies have created great value and given very good returns. Again, a business which has got very high entry barriers, obviously. And this was one company which was, going on its path, going on its right strategy, and Goa as a destination for tourism is improving by the day. So all the kind of stars align to make Delta Corp a great buy. But then, we have this regulatory, I would say, hammer.
A regulatory mountain, sir, not a bump. It's a regulatory mountain which is staring sharply at all e-gaming companies. But in your independent assessment, sir, I understand you've made a disclaimer that you are a shareholder at Delta Corp. But in your independent assessment, is it fair to look at games of skill and games of chance in the same breath?
I see this business is going to keep on scaling. They just need to figure out a way to get around all these GST related issues. And when that can happen is a big question mark. So there's so much of uncertainty surrounding such businesses, including Delta Corp, which is why I think there's no point investing in at these levels. But like me, if you're already an investor, then I would say the time to sell is gone. And just matter to just remain more or less invested and hope for the best.
Right, Mr. Mehta, hoping for the best, not just for your own holding in Delta Corp, but I think for all the gamers out there and the gaming firms which are in their own bit adding to the economy. Wishing them all the best and good luck. But Mr. Mehta, for now, thank you so much for joining us, and we hope to have you back with us very, very soon. Have a lovely day, sir. And Suyash, I think I can't let you go right now, because I think the big headline which also came out from the trading day today, of course, was JSW Infra IPO. Tell me all about it. I think our viewers are really curious. Day one saw just about 0.8%, 0.28%, 2.28% subscription. But take us through the details. What do we have?
Now, the JSW Infra IPO, which was much awaited on the street, finally opened today for subscription. Now, this is the first IPO from the JSW group in 13 years. The last time they came out with an IPO was back in 2010 when they carved out their energy business. Now, as of 3 p.m. today, JSW Infrastructure IPO was subscribed by about 0.28 times or 28%. Now, retail category saw an oversubscription of about 1.08 times, whereas the QIB book received no subscription. QIB players usually come near the end day of the opening of subscription. Now, NII book, which is the net, which is also category, was subscribed by about 0.3 times. Now, let me also give you a quick lowdown about the key dates of JSW Infra IPO. Now, the IPO, as we know, opened today. It will be open till September 27th, which is Wednesday. Now, the basis of allotment, which is basically the date on which it is decided how many shares each investor would get, is October 3. Investors who are not allotted, shares of JSW Infra will get refunds back in their bank account on October 4th.
T+1 is kicking in right now. We can see this kicking in.
Exactly.
Right.
So, and the shareholders and the investors who get allotment in the IPO will get their shares credited to the demat account on October 5th. And the listing date, at least as of now, tentatively is expected to be October 6th. Now, let's also look at the price band and the lot size of JSW JSW Infra. I think there is some mistake over there.
Yeah.
So the price band of the issue was fixed at about 113 to 119 rupees, and the lot size of the IPO is fixed at 126. So this means that retail investors who wish to subscribe to the issue have to bid for a minimum of 126 shares or in multiple of 126 shares thereafter. Now, as we know that you can't bid for more than 2 lakh worth of shares. The IPO, the maximum amount of lots that you can bid for in the JSW Infra IPO is 13, which works out at about 1638 shares. Now, minimum application amount for retail investors, Karthik, at the upper band works out to be about 14,994, whereas the maximum investment is capped at 1,94,922. Now let's also look at the IPO size. Now JSW Infra plans to mop up around 2,800 crore from the public issue. Now of this, the company has already raised about 1,260 crore from anchor investors on September 22nd, which also included Monetary Authority of India, of Singapore, Morgan Stanley, Goldman Sachs, Government of Singapore, HSBC, the Master Trust of Trust Bank of Japan, and so on. And the IPO, Karthik, is completely a fresh issue of shares. So there is no offer of sale from the promoter group, and the entire issue will be of fresh equity, fresh issue of equity shares. Now looking at the objectives of the IPO, now the proceeds will be used to repay debt of about 880 crores, whereas about 1029 crore will be spent on funding for funding capital expenditure requirements. Looking at the financials of JSW Infra, in the last 3 years or so, the assets of the company have grown at a CAGR of about 9.5% from 7,191.85 crores in FY20 to about 9,450 crores in FY23. Now revenue has grown at a CAGR of about 40% from 1,237 crore to 3,372 crore. Profit after tax, Karthik, has surged a whopping 56% in the last 3 years, from 196.53 crores to 749 crores, whereas the net worth or the market capitalization of the company has grown at a CAGR of about 17% from 2,488 crores to 3,934 crores in FY23.
All right, Sayash, JSW Infra IPO that opened today, 25th September, open till Wednesday. I think the only thing that comes to mind, Sayash, is that on a 3x, almost 3x revenue growth, profit after tax has gone up about 4 times. So I think that is one key metric that any potential investor would be looking at very closely, that, hey, this seems to be a high margin sort of a business to be invested in. But
and their margins are better than Adani, which is their direct competitor.
Absolutely.
Like JSW Infra is the second biggest port operator. Adani Ports is the top biggest.
Absolutely.
So they have a margin of about 50%. They currently have a margin of about 56 to 57%.
Super. Thank you so much for those insights, Suyash. But let's move on let's move on to another story, and a fairly interesting one, and that we've been tracking actually since 11th of July, and almost 2.5 months on. Nothing really seems to have moved in favor of those at the receiving end of what really transpired. Now, let's go back to this story. In its 50th Council meet on 11th of July this year, the GST Council gave what many called a body blow to the online gaming industry. It said that all online gaming, whether a game of skill or game of chance, will be charged GST at 28% on full face value. Let's imagine this. A game of poker that arguably requires at least some amount of skill will attract the same tax as, let's say, a game played in a casino that involves perhaps only chance. And full face value means that if a gaming platform receives 100 rupees from a gamer, 28 rupees straight up will go as GST. Now for a gamer, if you're a gamer, and it's important for you, if you're a gamer, to gain even 1 rupee on your 100 rupees spent, your winning would actually have to be a full recovery of the 28 rupees of GST and then another 1 rupee of real winning, making it a total of 29 rupees. Now this, as per gaming firms, has a very, very slim probability. Now, cut to the 51st GST Council meet. The Council further said that these rates will come into effect only on 1st of October 2023 and may not be enforced retrospectively. Now, if this 28% GST was a body blow, news emerging today is suggesting that 80 e-gaming firms are retrospectively being charged with GST evasion of up to 31,000 crore rupees. That seems like a death blow. Is it or is it not? Well, I'm not the expert here to answer this, but joining me to discuss this is Aarathi Ganesan. She's a journalist at Medianama who's been following this story very closely. Aarathi, thank you so much for joining us here this evening on Business Plus. First up, do you think it is fair on account of the government, which had said that this is, number one, it said it's a clarification and it's not a rate change. And number two, it said in the 51st GST Council meet that these rates are not going to be applicable retrospectively. Is it fair on the industry for such a blow amounting to as high as 31,000 crore rupees today emerging out of nowhere?
I mean, a question of whether it's fair or not really depends on who you're talking to. The first thing I'd like to clarify over here is that this hike is for online skill games involving wagering. It's not necessarily on video games. It's not on games like Wordle or the crossword that you might play online every day. So there's a very specific category of games that this hike is sort of attacking in that sense. And there's a reason for that as well. If you kind of look at what's happened over the last few years, what you're seeing is the government and its various authorities increasingly arguing that it doesn't matter if you're playing a game of skill or not. What you're essentially still doing as a user is putting down money on an unknown outcome and then hoping for some reward in the future. No matter how skilled you are, that's the premise of many of these platforms.
Okay, yeah,
and
so I think Finance Minister had come out openly, Aarathi, and said that, you know, as Ministry of Finance, as tax authorities, we are not concerned about skill or chance. All we are concerned about is tax. But my next question to you in the same light then is that, is it fair, even from a tax perspective, forget chance or skill for 1 minute, even if you look at the tax perspective, is it fair to charge a full face value GST, or should it just be the gross gaming revenue, which platforms refer to as the platform fee?
I mean, ideally what's been happening till now is on gross gaming revenue. And in that sense, it could be termed as unfair for the gaming platforms because they've essentially been doing what they were doing based on the regulatory understanding at the time. And the government took its own time to actually come to this agreement a few months ago. So in that sense, yeah, it could be considered unfair, and you're looking at really existential numbers for the industry. The Gamescraft order, I think, was 21,000.
That's right, 21,000 crore.
Today, exactly, and today's, I think, if I'm not mistaken, is 13,000, and I think some media outlets said that's the second highest that we have so far. So these are companies that did what they did based on the understanding at the time. The order, the decision comes later, and then they're kind of having to face the music. We're seeing reports of hundreds of people being laid off, which of course has its own consequences for the industry and just innovation as well. But coming back to my earlier point, I think as long as we're talking about these kinds of games, they do have certain addictive effects that have not been adequately explored, which do seem to appear like gambling effects as well. Like those could be just addiction, losing money, indiscriminately putting down money. And that's perhaps the reason the government took the step that it did. And it's something that state governments have also been arguing for a long time, that people are getting addicted to these platforms. They're dying by suicide because they're losing such huge quantums of money. And there's just simply not enough regulation around the area. And so that's perhaps one of the reasons that we're seeing what's happening today.
All right. So I think, you know, for the sake of our viewers, Aarathi, let's just run through the sequence of events and let's see, you know, where it all started and how many hurdles have been crossed or created in thus far in the last 1 year. So I think you're referring to Gamecraft, and I think Gamecraft really got that first tax demand in September last year. It's been exactly 1 year. Let's look at the sequence of events. September last year, a 21,000 crore rupee tax demand was slapped on Gamecraft technology, and this notice incidentally was quashed by the Karnataka High Court. Now, cut to a little while later, you also had the GST network, actually the GST Council or the Ministry of Finance or the Revenue Department challenging this Karnataka High Court ruling, and that went to the Supreme Court, and the Supreme Court stayed the Karnataka High Court ruling and is now likely to set a precedent. So, it said that the Karnataka High Court ruling will not be set as precedent, and a new ruling is expected to come out either end of this month or early next month. Now, today we see Delta Corp receiving a tax demand of about 11,139 crore rupees, and on account of that, of course, its share price also going down almost 19% or so in a single day's trade today. So, Aarathi, coming back to you, this has been the chain of events, this has been the sequence of events, and a lot of people who are part of the industry or industry associations fear that a tax wagering like this could actually see gamers who want to play online games, whether of skill or chance, who live in India, not hopping on to Indian gaming platforms, but international gaming platforms where their 100 rupees spent gives them full value of 100 rupees to play, and not 100 minus 28, which is 72 rupees.
Right, that is a real fear that the industry has brought up. The allegation is essentially that these are offshore platforms that operate outside of India in jurisdictions registered in the Caribbean islands and other places like that. And as someone on Twitter pointed out, any money that you're kind of pledging on those platforms isn't really going to be accounted for by India's tax net, so to speak. So it is a concern, and I think the biggest thing is just simply that they're outside the regulatory net, that you could have predatory platforms that hurt Indian users' interests, where you have people being preyed upon, people being sort of lured into false promises. And so that is a big concern that, with these kind of highly diminished returns, where you're essentially getting nothing back for what you're putting in, you're going to see a large scale migration to these offshore betting platforms. That being said, those platforms have been addressed to an extent by the online gaming rules, which also came earlier this year in April. And the Indian government has essentially said that no platform or intermediary in legal parlance can host games that haven't been verified under the rules. And platforms like this would fall under that, according to experts. So we could perhaps see some kind of limitation in terms of accessing, perhaps through blocking access to those websites. But the internet is a multi-headed beast, and people often find a way to access them anyway.
No, that's true, of course, and with the dark web and with VPN networks, etc., I don't think that's going to be a challenge at all. But Aarathi, before I let you go, one final question to you. What it seems right now is that this 28% GST on face value across all e-gaming does not benefit the gamer, does not benefit the gaming firms, and only shores up more revenue, perhaps some would call unfair revenue, for the government. And if that is the kind of tax structure, GST structure, that the Indian government wants to impose on new age industries like gaming, is this going to further weaken, or do you think there's a contrary strengthen other investments coming into the gaming sector from international players?
So it will definitely hurt the real money gaming industry. It will definitely disincentivize it. And I think that's a fairly clear mandate from the government. I believe the statement from the finance minister is we can't be taxing these industries at the same rates as essential goods. So they do want to impose a cost to prevent social harms such as the ones I spoke of. What I do think, incidentally, this is also doing is hurting other gaming industries. We were speaking to representatives from the video games industry in India, which is also growing. And many of their global investors, after this hike was announced, remained concerned that, oh my God, are we investing in a project in India that's a gambling project? We thought we were investing in a video games project.
Right.
And that confusion is happening again because we're conflating all these different types under the e-gaming bracket and sort of sounding the death knell for the gaming industry when it's really just a specific subset. So I think unless we get that terminology clear, apart from the real money gaming industry, we may also see other gaming industries in India being hurt because of this association with gambling that's happened with the tax hike.
Absolutely, Aarathi, agree with you completely. And thank you so much for joining us here on Business Plus this evening. Have a lovely evening ahead. And let's move on. Let's move on now to perhaps the biggest story, in recent times that we've been tracking, especially after G20 and the timing of that story, really playing out right now in the international circuit, where political tensions between India and Canada right now is at its highest ever in recent history. Now, after Canadian Prime Minister Justin Trudeau alleged India's role in gunning down of separatist and deemed terrorist Hardeep Singh Nijjar, which India vehemently denied and called absurd as well as motivated, both countries resorted to expelling diplomats, and India now even cancelling OCI cards of dozens of Khalistan supporters. Now, the big question we really need to ask today is, will escalated political tension de-escalate trade? Let's sample this. The India-Canada bilateral trade, as per Canadian government data, reached nearly $9 billion in 2021. And broadly, this is what it looks like. India imports fertilizers and energy products like coal, and coal's byproducts like coke and briquettes from Canada. On the other hand, India exports consumer goods, garments, engineering products like auto parts, aircraft equipment and electronics to Canada. Now, overall in the pecking order, Canada is India's 17th largest foreign investor, pouring in more than $3.6 billion over the last 2 decades. Canadian portfolio investors as well as its state pension fund has invested billions of dollars in Indian stock markets and debt markets as well. Now, even as this trade hovers around $9 billion, it's split pretty much equally between India's imports and exports. So, the battle of what is being called an eye for an eye for both countries right now is such that if you win, you both stand to win, and if you lose equally. Let's try and make sense of this escalation politically and potential de-escalation with our dear friend, independent markets and trade commentator Srinath Sridharan. Hi Srinath, thank you so much. Good to have you back on Business Plus after a while. Very simple question. Politics and trade, do they work in tandem, or are they absolutely mutually exclusive?
I mean, they do work in tandem depending on what kind of sector. But if you look at the Canadian investments in India, it's largely investment based, not necessarily trade. I mean, they're the 17th trading partner for India. Two, I think pension funds which have invested significantly in India are not those who are going to pull out just because the government said so. These are deep-rooted pension funds which invest in long-term businesses. India has a long-term business potential for a lot of these investments. So they don't see escalation. India has far more stable governance as we speak. So I don't see this as having any cascading long-term effect. If at all, I think I don't want to trivialize it, but I think it is a sulking politician trying to garner domestic attention by calling out a large democracy. I mean, I would probably bring it down to that extent. I mean, not really anything else.
Yeah, sure. I am not sure I disagree with you completely on that, Srinath, if at all I agree with you. But largely, I think the question I want to ask is that, and let's just talk geoeconomics and leave aside geopolitics right now. Any sort of rift between an emerging economy as large as India and an established developed country like Canada also is likely to have a direct bearing with India's trade with US, India's trade with Australia, India's trade with the UK. So do you see any of that playing out in the pure realm of geoeconomics, where right now there is a very clear wedge, a very clear split between India and Canada, but this bilateral trade is not, is not compartmentalized as bilateral alone in the connected world that we are living in?
See, connected world, absolutely yes. But it also shows how Europe has behaved in the entire Russian sanction game in the last 1 year, right? I mean, they all spoke about sanctions, but yet each of them were dependent on Russia for large commodities, including oil. And they found a way, including working with India, to get those, to keep them warm in the winter. So I think whether it's Australia or whether it's the US, they always also played what is good for them bilaterally. I mean, while they're all part of the large multilateral institutions and regional blocs, they will have to appease to their own population. Look at US, for example. Despite all the stands it speaks or it has spoken about China, and despite all the controversies about China and COVID-19, has US stopped anything? I mean, they made all the nice optically sounding good rhetoric about we will shift our supply chains to regional supply chain. Yet, Chinese factories power bulk of the US households, and that's a reality that they can't get away with. So I don't think US or UK or Australia are going to burn their bridges with India. Each of them need, India today offers two aspects, according to me, to the globe. One is India is a large consumption market, not necessarily by value, but definitely by volume. And those numbers are picking up constantly as Indian GDP grows. Two, I think more importantly, for each of the long-tailed investment vehicles, when I say long-tailed, I'm talking about pension funds, insurance entities, large family offices from US, UK, Australia. They're all, mind you, they all have good, deep pocketed insurance and pension funds, and they need locations elsewhere outside of the usual known suspects of each other and Europe. So which is why India is a very, very attractive destination for them. Until recently, India had a lot of what they would have called as a governance risk premium attached to every return expectation. Not necessarily anymore.
Not anymore.
Not anymore. Not anymore. So which means that they cannot, they might, let's say they might be pissed off with India, but they don't have a choice but to deal with India. They need Indian consumers and they need Indian investments. So which means they have
if I can add to that, Srinath, before I let you go, we are running out of time, but it's a perspective, not really a question. And the perspective I want to offer is that I think Canada has a lot more to lose by splitting ties with India as compared to India, because look at the constitution of the Canadian population. I think there are far more number of Indians contributing to the Canadian economy sitting in Canada than Canadians back in India. So I think for Canada to imagine a scenario where the nationalist jingoist sentiment of Indians rises, I think it'll be very difficult for Canada to keep its own economy alive and leave aside bilateral trade. I'm talking pure contribution to the Canadian economy by Indians is going to be a far bigger hit to Canada if that were to sort of go out, as opposed to severing ties with India and India standing to lose. What do you have to say to that?
No, I think absolutely. I think it boils down to domestic politics. For them, they're trying to do this jingoism about Canada, about governance aspect. But I think the larger question is it all came about the same week as their own local electoral sentiments, right? The opinion polls were showing that Trudeau was going down very, very badly. And all these allegations came around the same time. So if you put two and two together, in the world of geopolitics, there are no coincidences, right? These are all well-planned, probably strategies.
Absolutely.
And in the entire G20 summit, one of the low-key nation was probably Canada. We saw a lot of videos floating around in the media that how other global leaders were also ignoring Trudeau's overtures, so to speak.
Absolutely. Well, I'm not sure how the vote bank, and especially that of people of Indian origin, is really going to play out for Justin Trudeau if this really is a politically motivated stand that he's taken. But Srinath, thank you so much for joining us here today, and we'd love to have you back as and when we have great stories like we always do here on News 9, especially on Business Plus. So thank you so much, Srinath, for being here with us. And before we end the show, of course, a big announcement about a big show, the big show at 10 p.m. today. Duologue with Barun Das, TV9's MD and CEO Barun Das in a candid conversation with Z Entertainment's Chairman Emeritus Subhash Chandra. Don't miss that at 10 p.m. today. Here's a short glimpse of that before we go.
How do you see the role of Mr. Kejriwal?
I doubt that Aam Aadmi Party and Mr. Arvind Kejriwal can do any good to this nation.
You don't trust your employees.
If they go out of their mind, better they leave.
A person like Rajat Sharma or Sudhi Chaudhary, do you feel it would have been better for your cause if they had stayed back?
Duologue with Barun Das, featuring Dr. Subhash Chandra. World premiere on Connected TV. Tonight at 10. Only on News9 Live. India's first and only digital exclusive English news stream for Connected TV. Supported by Alliance Broadband.
मैं इमरान अहमद खान नियाजी सबके दिल से हल्फ उठाता हूँ.
When Imran Khan came initially into politics, he thought his personal popularity would be sufficient for him. It didn't happen.
The retired military generals
are openly saying that Imran Khan is a better choice.
Imran Khan may have bitten a bit too much, more than what he can chew.
Implosion. This and more. Streaming on world's first news OTT. News 9 Plus. Download now.
Under the leadership of Prime Minister Modi, G20 will keep moving forward.
Long believed that the relationship between the United States and India is will be one of the defining relationships of the 21st century.
There's of course the G20 in New Delhi, and I absolutely can't wait to be there.
भारत मदर ऑफ डेमोक्रेसी है। हम राष्ट्र को भी एक परिवार के रूप में देखते हैं और विश्व को भी एक परिवार मानते हैं। वसुधैव कुटुंबकम।
Our effort is really to use the G20 to make the world ready for India and India ready for the world.
Lights, camera and the world stage is set for India's spotlight moment. It is touchdown New Delhi as the world's most powerful heads of state converge in the national capital for the 18th edition of the G20 meet on the 9th and 10th of September 2023. The powerful G20 countries are meeting at a time of great geopolitical strife and economic instability. At such a time, India's leadership promises to be one of inclusivity, compassion and cooperation. Vasudhaiv Kutumbakam, one earth, one family and one future is India and Prime Minister Modi's message to the world.
For the Ministry of External Affairs and for us diplomats, this is like a Chandrayaan 3 moment.
Every Indian can feel proud of the fact that we will have, in many senses, one of the most unique and unprecedented presidencies of this very important organization.
I'm the G20 Sherpa. That means my job is to enable my leader, the Prime Minister, to reach on top of the Mount Everest.
Founded in 1999, after the global financial crisis of 1997-98 as a forum for finance ministers and central bank governors, the G20 is indeed the Mount Everest, where the world's largest economies converge. This is where global governance is shaped to address international challenges and seek collective cooperation to geopolitical, strategic, economic, social and environmental challenges. The Group of 20 or the G20 comprise 19 countries and the European Union. And here's some interesting trivia. G20 is not about 20 countries. It's actually about 43. 19 countries plus 27 members of the European Union. Together, the G20 members represent around 85% of the global GDP, over 75% of global trade, and about 2/3 of the world's population. For India, taking over the G20 presidency in 2023 is a rightful assertion of its power in the global south.
Our intention is very much to be a champion of global south.
What is the global south? These are the developing nations of the world, which together make up 39% of the world GDP and face the biggest impact of the world's challenges. Emerging economies of Latin America, Africa and Asia make up the global south. India has consistently championed their voices and will use the G20 platform to further amplify their aspirations.
Not only the G20, but even earlier when we conduct foreign policy, our approach is human-centric globalization. How can India contribute to the larger global common good? How can we as a country that today is the fastest growing large economy in the world, a country that has just successfully landed its spacecraft on the moon, a country that is at the leading edges of digital public infrastructure and digital transformations. We have, in many senses, created the example of a successful and inclusive development model that we can share with the rest of the world.
Job losses, business closures, and disruptions in international trade impact most